Let's start with the big news, which is midnight tonight, and those tariffs that are coming due on $34 billion of imports from China. China said they're going to retaliate right away. Is there a way to stop this thing? Is there a way to stop it from just escalating and escalating and escalating?
Well, you know, it's hard to see how we're going to stop something that's going to happen within the next 24 hours. I just don't see a catalyst to be able to stop that. To some extent, you almost have to start the fight to realize what a bad idea it is, and then have both parties maybe step back a bit. But, you know, this Friday, tomorrow, we're going to get slapped with tariffs primarily on commodities. These are red states who voted for the president. This is a big hit. We already have a surplus of cheese. We're going to have a surplus of soybeans. It's just not good for the U.S. farm. So, and then, of course, China will get hit. So tomorrow, I wouldn't say tomorrow it starts, because I think it's already started. We're already seeing the repercussions. We're already seeing prices increase. We're already seeing some people losing their job in the U.S. But tomorrow it will escalate, no question.
And we're just showing right now soy elevators by congressional district and the concentration through the Midwest, upper Midwest, the possible political ramifications of that. But put on your hat as a CEO again for a moment. If you're a CEO, how do you deal with these issues as you try to plan, make capital investments, make decisions that are longer-term decisions? Thus far, it seems like the markets have not reacted too much to the trade talk.
Yeah, I think, you know, if you're a CEO, you've got to be very careful, because you can make a strategic decision and 3 months from now realize that you didn't have to make it because the tariffs are off. So, for example, we know companies who are losing market share and losing money because of the tariffs slapped on some of their inputs. They can't sell competitively in the U.S. or outside of the U.S. That company can choose to close down and open a factory someplace else. But I think it's worthwhile waiting a little bit, even if you have to take a hit. The important thing is to get through it without making decisions that you'll regret. Aluminum and steel tariffs are not going to be here forever. In fact, if the president wants to get NAFTA done, we'll probably see those tariffs taken away from Mexico and Canada very soon. So I would say make whatever tactical moves you have to make, but wait as long as you can before you disrupt your supply chain.
So talk about NAFTA for a moment. You took us there, and you know the situation very well. We now have a new president, Mr. Luis Obrador, down in Mexico. Is there any realistic chance of getting a NAFTA deal done before he takes office, which doesn't happen, after all, until January 1?
Yeah, it's an interesting question, because if I were on the U.S. side, I would want to get it done now and get it done as soon as you can, and get it done before he takes over as president, assuming all the stars align and we can get the U.S. side on that as well and get Congress. The problem with AMLO, as they call him, is not so much that he has it against NAFTA. He has said that he wants a good NAFTA deal. But if he is in power, he may have some priorities that go up against NAFTA. He's very interested in agriculture. He's very interested in bringing back agricultural products that Mexico lost because of NAFTA. So you just don't know if he's going to be a stumbling block or if he's going to be someone who will just make it more difficult. So if the U.S. wants a deal, they should do it quickly. And the first thing they have to do, that we have to do, is take away the aluminum and steel tariffs. Mexico and Canada have said they don't want to negotiate with a gun to their head. And they perceive these steel and aluminum tariffs as a tactic on behalf of the Trump administration to get them to the table. So the first thing that has to happen is let's get rid of these tariffs from Mexico and Canada so they can negotiate a deal and close it as soon as they can.
So, Carlos, do you have a sense, you cover this very closely, do you have a sense of how close we are to a deal on NAFTA? Let's assume for a moment, the president were to say, okay, fine, we'll take those off to get a deal. How close are the parties? They negotiated a long time. It seemed like they had a long way to go.
I mean, we're actually and then there's the rules of origin on cars, on autos, raising it a bit higher content inside of North America. Those should be issues that we can resolve. They are not, super. I would say the auto rules of origin are probably the biggest one. And it could be, again, the reason why we have this 232 investigation looking at autos. That could be perceived as the president using it tactically to get people to the table. But we've heard over and over again, countries are not going to negotiate with a gun to their head. So again, David, I think the first thing we have to see happen is take those tariffs away from Canada and Mexico. If the administration does that, that means they're very serious about getting a NAFTA deal soon.
So Carlos, autos, let's talk about that some more, because it's not just Canada and Mexico, but it's also Europe. And we had a report overnight that the U.S. ambassador to Germany had reportedly met with some European auto manufacturers and suggested maybe we could go to zero tariffs, which really affected the stock of those companies. Is that a realistic possibility? Because the president said last week maybe that they're close to a deal with the EU.
Well, no one is at zero tariffs. Maybe Singapore gets very close to it. But the problem with the automobiles is that it's not like, we ship a full automobile in and we place tariffs on it. An automobile can come from parts that are made in 8, 9, 10, 11 different countries. And that's where it gets complicated. The other thing, too, is, for example, General Motors, their biggest market is China. Well, they're now going to get hit in China. 60% of what the automobile companies in the U.S. import are for use inside a car. So what they're importing are raw materials. They're importing steel, aluminum, spare parts, different parts of the car, plastic. That will go up in cost. That means U.S. companies will have to raise prices, and if they sell less, they'll have to let go of people, or they won't raise prices, and their margins will drop, and they may have to go into a loss, and then they'll really have to let go of people. So the unintended consequences are so vast, right. And that's what I would ask people to keep their eye on. Not that there's 20% tariffs or 25 or whatever it's going to be on cars, or the 25% on steel. Right. It's the ripple effect, across the board that it will have. And those are the unintended consequences. And, David, we will start hearing about those a lot sooner than we see the numbers in our GDP. So we're going to hear in the earnings calls, we're going to hear companies talking about why their earnings are down. Well, it's because of tariffs. It's because of steel. So we're already beginning to feel the hit. And it will take maybe another quarter or so until it hits the GDP.